idiosyncratic risks. That's a new word into my vocabulary. Hello, AI Wizard here. It's been a while. Today, I have a nice video for you. We're going to compare Qwen 3 model with Deepseek. We're going to compare these two models originated from China and then see which one performs better in terms of the reasoning and answers. Alright? So let's dive in. I have the same exact questions for both Qwen and Deepseek, and the question is basically asking, so we have an investor that is considering two funds to invest to put capital into. The fund A is a long-standing fund that has moderate returns, 8 to 10%, very consistent, has very low volatility, and invest in more or less transparent and known equities. All right. Now, Fund B, on the other hand, is a newer fund with only 3 years track record. It has a very variable return and it trades within very volatile market. All right. So now the question is, which fund should investor lean towards and why? So here, which fund to go for might be a subjective question depending on the investor needs, because we don't have an exact investor needs specified. But what I want to see is how would these models reason about, how would they think about which fund they should go for? How would they understand what investors should be on lookout for? What kind of precautions, due diligence investors should perform in order to make sure they choose the correct fund? So we want to see the trade-offs, we want to see any issues or the good stuff, depending on what kind of decision there is. So fund A or fund B, all right? So we're going to start with that. And on the left, we have Deepseek here with the R1 reasoning enabled. And on the right, we have Qwen 3 with the thinking enabled as well, all right? So both of these are the latest models. So let's just hit send and let's see what happens. So we are technically not measuring the time here, but there is a delay between me clicking on both of these windows, but we can already see that Qwen 3 is actually much faster, which is interesting. So I wouldn't necessarily say that Qwen 3 as a model is faster, because this might be because of the infrastructure, because of the servers that these models are hosted on. Based on my experience, Deepseek, after their launch, they were so popular that they were not able to handle the server loads. Plus, as far as I remember, they were constantly under attacks by different hackers, different cybersecurity firms to try to break into their infrastructure. And therefore, the load was so high that they had to shut down their services for a while. And it was not very stable. The difference in performance might be because of infrastructure, but not necessarily the model, right? Let's see. So Qwen suggests us to go with Fund A to avoid over gambling. All right. Nice choice of words. And then for Deepseek, smaller allocation could be considered only. Okay, so it generally suggests Fund A, but considers Fund B. Actually, the same goes for Qwen. So they are mentioning the hybrid approach as well. All right, that's interesting. So let's just kind of go through and see what's the output. The investor should lean towards Fund A due to its alignment with their moderate risk tolerance and long-term horizon. Fund A's consistent returns, low volatility, and proven track record in stable assets provide reliable performance, reducing the risk of exacerbating recent underperformance. While Fund B offers a higher short-term return potential, its extreme volatility, unproven strategy, and exposure to emerging market risk conflicts with the investor's moderate risk profile and could worsen short-term results of market return. Yeah, so there is one information that I think I missed out. So we do mention that there has long-term investment horizon and moderate risk tolerance. So I forget to mention that. All right. Then okay, this makes sense. Then we see Qwen. So lean toward Fund A, prioritizing stability and alignment with their moderate risk tolerance while cautiously considering a limited allocation to Fund B for potential upside. However, the decision hinges on rigorous due diligence and risk management. Okay. This is interesting. So Deepseek at least like from this paragraph, right? It just mentions about Fund B, but it doesn't kind of like say that Fund B should be considered, right? Although both of them do say lean towards, so not necessarily the final decision. Okay, so let's see the way that Deepseek structures this. So Deepseek has key trade-offs divided by fund, potential pitfalls, okay, just bullet point, and then critical due diligence steps for each fund and general steps and conclusions. So for Qwen, we have key rationale, which is basically describing by rationale, and inside we have fund A, fund B, fund A, fund B specific points. Then we have trade-offs and pitfalls divided by funds. And then critical due diligence steps, which also has fund B, fund A, cross fund. Okay, it's divided by more specific sections. All right, okay. General structure, I think both of them are fine. Yeah, I think it's quite okay. So let's see the Deepseek first. So we have key trade-offs. Fund A, pro stability, predictability, and lower downside risk. And then cons may not sufficiently address short-term performance pressure due to moderate returns. Okay. Fund B, potential for high short-term gains to offset underperformance, high risk of capital loss, liquidity challenges, and strategy complexity. Sure. Okay, then let's see potential pitfalls. Fund B short track record makes it difficult to assess skill versus luck, especially in untested market conditions. Leverage and liquidity risk in emerging markets derivative could amplify loss during stress periods. Overestimating risk capacity to make short-term growth might lead to irreversible portfolio damage. All right, so basically what it's saying that Fund B is too young and has a very risky strategy in volatile markets, which, well, that's what we said, all right? So just kind of repeating us back what we said, but I mean, it is technically a pitfall, so all right, so let's just keep it. And then before we go to due diligence, let's check what Qwen is saying. So key rationale, alignment with risk profile. Fund A's consistent returns and low volatility match the investor's moderate risk tolerance. It focuses on blue chip equities, investment grade bonds, provides diversification benefits and stability critical for long-term horizon. Sure. So it relates Fund A's performance relates to our investor risk profile. And then Fund B's erratic returns and reliance on complex derivative and volatile emerging markets exceed the investor stated risk appetite despite its short-term upside potential. Yep, that's correct, because our investor is not a short-term investor and want to avoid aggressive risk. Yeah, Fund B might not make sense. So that's basically it considers by point what's the rationale for this decision. Then track record and transparency. Fund A's decade-long performance demonstrates resilience across market cycles, offering proven durability. Fund B's 3-year track record is insufficient to assess its strategy's robustness, particularly in stressed markets. Sure. Short-term pressure mitigation. While Fund B could theoretically boost near-term performance, its risk of sudden drawdowns, -5 loss possible, could exacerbate performance if timed poorly. Fund A statements reduce the chance of compounding losses. Okay. Trade-offs and pitfalls. Fund A risk may underwhelm in the short term, failing to offset weakness in other classes. Potential complacency if low volatility mass systemic risk. Or exposure. Okay, wait. Wow, this is a good point and something that we didn't provide it with, which means it did think about it, we could say. In comparison, Deepseek's trade-offs and pitfalls, the ones that it mentions, are exactly the same what we said. It's just that it's repeating it back to us. So plus point for Qwen here. I like this. Okay, so Fund B is okay. Liquidity mismatches, emerging market debt, and derivative may be hard to unwind during the crisis. Model strategy complex derivatives could harbor hidden risks, leverage, correlation breakdowns. Manager inexperience, 3-year track record may not reflect true capability in adverse conditions. Okay. Yeah, so again, here is like, I like Qwen's analysis more for the trade-offs and pitfalls of the like choosing between funds, because it elaborated and reasoned about it. Like, that's the most important thing. It thought about it nicely. Versus Deepseek, which essentially repeated back what we said to us. And even, okay, fine. So, for example, Deepseek here mentions the strategy complexity, sure, but what does it mean, right? It can expand a little bit to tell me exactly what it means, right? So I can understand what's the thought process, how it came to that. Like, what does it mean by strategy complexity? Because sure, it might tell me something, but I might be misunderstanding Deepseek, all right? So the Qwen is more specific in what it says here. Now, critical due diligence steps. All right, so we have Deepseek for Fund A. Analyze historical drawdowns during market downturns. Sure. Assess correlation with the investor's existing portfolio to avoid over-concentration in similar assets. Sure. Review fee structure and manager tenure for consistency. Sure. Then we have Fund B. All right, so basically understand the strategy. Okay, test the model under the stressful scenarios. Sure. Make sure that the team experience is verified. Sure. And then track record analysis, decompose returns, distinguish alpha skill from beta. Okay, sure. All right. Okay, that this makes sense. And then general steps, we have optional due diligence. Okay. So yeah, your let's just say like classic due diligence that is being done, right? Now, let's see what we have for Qwen. Fund B deep dive. Okay, strategy. Okay, demand granular transparency on. Yeah, sure. Okay, so that would be the same thing that we have here, with just different words. Evaluate stress test results against historical emerging market crisis. Sure, and verified team's expertise. Okay, sure. Let's see. Fund A validation, portfolio turnover, ensure low volatility isn't masking closed indexing or excessive concentration in overpriced sectors. Okay. Yeah, kind of similar. Yeah, exactly same. Then fee justification, confirm management fees align with the value diversification, not mere beta exposure. Okay, cross-fund analysis, correlation, measure how each fund correlates with investors' existing portfolio. Fund A may reduce overall volatility, while Fund B can introduce idiosyncratic risks. Idiosyncratic risks, that's a new word into my vocabulary. Liquidity terms, review lockup periods, notice requirements, and redemption gates avoid. Yeah, okay, so quite classic. All right, so for this specific scenario, for this question, for me, Qwen wins. Compared to Deepseek, more or less the answers are the same. So both of them are suggesting Fund A because of our investor risk appetite. However, what I like about Qwen is how it presented me with the trade-offs and pitfalls. It actually considered the details of potential pitfalls of Fund B and Fund A and accurately told me what it is instead of just repeating back what I said to me, right? So what Deepseek did is essentially just gave me the same thing that I mentioned in the scenario in the question, but rephrased. However, in Qwen, I do see some logical reasoning trying to understand the Fund B's and Fund A's potential risk and actually giving me the output that I need, all right? So there is much more reasoning in the Qwen's case here. So that's a win for Qwen. As usual, if you guys are interested in AI and you want to bring AI to your company and you work in the finance industry, go to our YouTube profile here, click on this URL, go to our website and book a call with us. We offer a specialized AI agents for finance industry. For now, you can check out more on our landing page. That's it. Thank you guys. Bye bye.